Hi, this is Randy Finney with Right Side of the Chart, and today is Tuesday, November 27th, 2012. In this video, I'd like to do a quick overview on the markets, where we're at and where I think we're going. And before I dive into the charts, I wanted to just mention some of the reasons for my overall bearish bias. For those of you who've been following the site for some time now, know that for the last few months I've held a longer term bearish outlook on the market, bearish bias, and among many factors, one of the key reasons for that longer term bearish bias are the weekly divergences. Before I get into that, before I look at the charts, let me just talk a little bit about some of the other factors here for my bias. The average bear market, or bull market, I'm sorry, if you look at the average duration, now when you Google average duration of a bull market, you will get all types of varying results, but the most common that I come across is about a 3.8 year, a little less than a 4-year average on on the average bull market. Some measures show longer durations, but that tends to be about the average. And right now we're 3 years, 8 months, and 21 days, so almost 3 years and 9 months into this bull market that started back in March 2009, when the last bear market there ended. As far as returns, again, those are going to vary depending on what source you look at, but the average gains tend to be around, I've seen numbers around 65% or so for the average bull market. And from the lows in March of 2009 to the recent peaks, the S&P was up somewhere approximately 120%, I think it was, and the NDX about 180%. So whether this bull market has several more years left in it, several more months, one thing we do know is it is getting pretty long in the tooth here by most metrics, by time, and especially by percentage moves. So is that in itself a reason to become bearish or short the market or pull all your longs off or be cautious on the long side? Absolutely not. In fact, usually at the end of a bull market is when you see some of the largest gains in the final stages of a bull market. Just because a market is getting pretty extended in itself is not a reason to become bearish. However, taken in light with other factors, it may be, and that's what I'm going to talk about here. So keep that in mind, that when I factor this in and talk about divergences and lack of fear and other things that are going on, that it all ties in to the fact that we are in most likely the latter stages, if not the final stages of the bull market, or maybe even the early stages of a new bear market. I'll talk on divergences in a second, but the other thing to mention, and I've talked quite a bit on this in the past here recently, is the economic cycle. Most of the key metrics are trending lower, and many of those are at or near historical recession levels. So it appears to me that not only are we at the in the most likely in the tail end stages of a bull market, but as far as the business cycle goes, which makes sense, we're most likely at the end of that as well, and possibly in the early stages of contraction or recession. So that's another factor. And then finally, coming back to these divergences that I talked about, and this again plays into the longer term bearish bias. If you look at the weekly chart here, we're taking a look at the S&P 500, and I'll open this MACD up, stretch it out a little bit. We had such a low on the MACD back in 2009 that it almost skews it when you take a look at it. So I'll have to stretch it out here so we can see these divergences. But here's the bull market that went from 2002 all the way up to the top in 07. That was one of the longer bull markets on record. As you can see here, if you take a look at the MACD, we had multi-year. If you take this line, these peaks back in 04 all the way up to the top, or just before the top in 07, we did have negative divergence there in place. We had strong positive divergence towards the end of the bear market, or put in place at the end of the bear market in 2009. As far as time frame goes, it's a much shorter time frame, and that makes sense, folks, because bear markets And stock market corrections tend to happen a lot faster than, in other words, stocks fall faster than they rise. So it's not unusual to see a bear market play out a lot quicker than the preceding bull market. Same with stock corrections. If you take pretty much a look at any corrections along the way, you can see that usually weeks to months of gains are wiped out, usually in just days or weeks here. So as we see here, and so you're going to see shorter term divergences typically on the during the corrections and bear markets. But if you look at the major corrections that we've had in the S&P since this bull market began, we had negative divergence here at this point, and that led to a very sharp correction back in 2010, as you can see here if you follow my mouse. And now we're looking at a much longer, much more powerful divergence in place. Again, take a look at this yellow line here at the top of this wedge type pattern against the divergences down below on both the MACD and the RSI. Try to grab this here. A little trouble with the charts. There we go. You can see that we have solid longer term divergences in place, and from my experience these type of negative divergences don't manifest themselves in such a small correction as we've had so far. So it remains, and I've talked a lot about this in the past, I've done a lot of these market overviews and charts, it remains my opinion that before all is said and done, the markets have probably most likely seen their highs at this point, and that we are not going to go on to make new highs anytime soon. In fact, we'll probably see much lower lows before we see higher highs. Okay, and let's take a look real quick at the NDX. Similar story is the SPX. We've broken this long-term bull market uptrend line. We're well below that. Very impulsive selling. Negative divergences in place at the top. That's not really drawn out here on this chart. Let me add a line here. If you look at these, the recent peak to peak highs, the higher high in the prices against the lower lows in the MACD and RSI. So there's the NDX. NASDAQ Composite, if I can type this in, CompQ, there we go. NASDAQ Composite, same story, negative divergence, actually double negative divergence in place on the MACD here. We had negative divergence here on this larger wedge type pattern, and then more recently, if you can see here on this peak. So anyways, again folks, this goes into my larger, bigger picture thought process here, is that we're seeing these divergences now almost 4 years into a bull market. And had we seen divergences, which we have had, they're not all shown here. We've had divergences on the daily chart and some smaller divergences on the weekly chart, like I showed a minute ago on the S&P 500, and those did play out for a nice correction, but they didn't result in a bear market. However, those were a year or less into a new bull market. So when we get such long-term, powerful, multi-year divergences at almost 4 years into a bull market that is anywhere from 120 to 180% off the lows, that tells me that the uptrend is most likely in or already at its final stages. In my opinion, we've peaked, and as I said, I don't think we're going to see new highs anytime soon. Okay, and to wrap this video up, let's talk about another factor, the final factor that goes into my bearish bias. Again, to summarize those, we're nearly 4 years into a bull market. We've well exceeded the average gains for the average bull market from the recent, where we were at the recent highs. We have solid divergences across just about every index, every major index out there. Divergences all the way out on the weekly and monthly time frames. The economic cycle has, in my opinion, has been trending lower throughout the year. Yes, there are temporary blips and good news here and there for the bulls, but overall the trend has been lower. Again, I've made those points in the past. And finally, something I've talked a lot about recently is lack of fear. I know there's so much talk about sentiment numbers that come out week to week and swing around. I look at things such as the put-call ratio, the VIX. where traders are actually putting their money, not where some of these surveys come in. It's a lot of rhetoric, whether a fund manager is telling you he's bullish or bearish going forward. It's where's the money at, and what's the market action, price action look like. So let's take a look at the VIX here. What we're looking at, the white line here is an overlay. This is the S&P 500, the white line, and the red line is the VIX. And one of the things I pointed out recently is, let's take a look, focus on these green circles up here. I have 3 green circles up top on the S&P. One, this is the second, 2, 3. So we have 1, 2, 3. And those are in the last 2 years. We're looking at a span that goes about 2 years on the chart here. These are all the major tops, or I should say interim peaks in the market that we've had. So the market peaked back here, and that was May of 2011, and those were the highs before we had this vicious sell-off down here. Very large correction back in 2011. We had again another peak here, May 2012. Which led to a very sharp correction. And so far where we're at, we've had this peak down back in September in the S&P 500, and here's where we're at today. So I'll talk a little bit more about this one, but let's go back and look at what's happened in the past. In the beginning, there's an old expression on Wall Street that markets climb a wall of worry, and that's typically true, especially in the early stages, even in the first couple of years of a bull market. Where this bull market followed one of the most vicious bear markets we've ever seen, and so there was a lot of skepticism and fear. And every time that we had any type of sell-off, let's take a look at what the VIX did. I'll put my crosshairs. Pay attention to the vertical line, which is coming in here at the peak in the S&P. And now let's go down below. Here's the corresponding level in the VIX. And as you can see, we had a relatively muted correction. In fact, let me take a measuring tool here. Let me put a line on this. And I'll just want to point something out. I did this a couple weeks ago in the blog. That correction back then was right about in scope and time equal to the correction so far that we've had when the market bottomed about a week or so ago here. And now let's take a look at what the VIX did. Okay, let's down here below, let's look at this reaction in the VIX here. So we had this huge sharp spike, considerable spike, and let's just go ahead and measure that out. And you can see how much fear came into the market. And let's look at this other recent peak. As you can see, nowhere near, little bit over half the reaction that we had in the VIX. And then let's take a look at this other top here, at least down to that point. To compare apples to apples, I put the line here. So if you look at the distance from the top to bottom, that measures the amount of the move down over here. And let's look at where the VIX was at that time. So we went from down here at the lows where the green line is. The VIX spiked all the way up to right around this level. So again, a much larger response in the VIX on those last two tops. Fear came into the market, and yet we still had these type of corrections. And now the other thing I wanted to point out is similarity in patterns. Let's look at the top here. This is a typical top. We have the first major sell-off. The Elliott waivers will deem this a wave 1 down. Usually if it's a 5 wave, a longer term move, we have wave 1 down, wave 2 up. Here's a big powerful wave 3 down, 4 up, and then 5 down. So third wave is usually the largest. You can do the same here. 1, 2, 3 down, 4 up, 5. So either way, we have that first wave up where the bulls are buying the dip, think everything's good. We have a lot of shorts that cover early, take quick profits, and then usually the next big wave down. And that's what I think is coming here very likely soon. But if you look at what we've seen so far in the past on these big corrections, we have always seen that first big counter trend rally that failed to come up to the previous highs, and then there was a lot more selling to come from that point. Something I wanted to take a look at here too, if you look at these yellow circles, as you can see in every case, the VIX made a higher high, so you had divergence in that case. The VIX making a much higher high than it did previously, and to me, that looks about exactly where we are now, especially if you look at this correction back in 2011. Look at the similarities in the VIX. If I put a horizontal line here, you can see the VIX has really come down to about the level that it has. Take a look at these yellow circles down here. One here, the yellow circle here, and the yellow circle here. So either way, the VIX is at the bottom of its range, and anybody that follows the VIX or is even somewhat familiar with it knows that the VIX at the bottom of its range, and this is a multi-year range here. I know I'm only showing 2 years on this VIX chart, but that shows complacency. It shows very little fear in the market, very little volatility, and so keep that in mind. And I think that the lack of fear this time around, especially since we had such a very muted response from the peak, considering this sell-off, and again, I've highlighted here when we've had similar sell-offs in the past, we've seen a much sharper spike in the VIX, a lot more fear come into the market. Now, again, this is typical final stage bull market topping pattern. There just comes a point, it's like the boy who cried wolf. We've had enough corrections, enough fear, and now we have, the world is saved. We have the Bernanke put, stocks are going to go up forever. And I'll tell you, it's just something that never changes throughout time. Towards the latter stages of a bull market, people tend to think that it's different this time. And I think that's a very dangerous fallacy. And I think finally we're seeing it evidenced in the market that there is very little fear. And people are now treating every correction as a buy the dip, opportunity. Thank you. So anyways, folks, that's what I wanted to point out, and this is something to keep an eye on here. As far as timing on this, it is my belief that it is just a matter of days, possibly a few weeks. We could push higher here. Of course, the market can keep going higher, can do anything it wants, but I'm of the opinion, based on what I've covered here today and a lot of other factors that I don't have time to discuss in this video, that the upside is very limited from this point, and the risk reward right now is skewed to the downside in the markets. Okay, this has been Randy Finney with the Right Side of the Chart, and I hope you enjoyed it.